Okay, so guys, let us go ahead and take on an example on startup valuation. This particular topic, that is valuing a startup using the first Chicago method, is discussed in your study mat in chapter number 13 on business valuation. Now, why this name? Because this method is used for valuing startup by an entity called First Chicago Investment Corporation, which is supposed to be a subsidiary of the First Chicago Bank in the US. Is that fine? And that is the reason we give this name for this method, where they use a combination of the DCF analysis and they use something called the exit multiple and value the startup. Now let's read the background of this method and then take on a numerical example on this. And there is another example in your model test paper number 9, which will be the second example discussed. That will be another video, okay? Now let's go ahead and discuss the theory part. Yes, sir.
The First Chicago method is named after the First Chicago Corporation, a major US bank that later became part of JP Morgan Chase.
Okay.
This method was developed and popularized by venture capital arm of First Chicago Bank, specifically First Chicago Investment Corporation in 1980s and 1990s.
Okay.
Why the name? Because the bank used this approach consistently when evaluating early stage and high risk investments, especially startups with uncertain futures. The method came to be associated with them and took on their name.
Is that fine? And that is the reason this method of valuation is known as what? The First Chicago method. And this example is in your model test paper 9. Let's go ahead and take on this extra sum. Yes, Subhash, take us through the question.
Example 1, assumptions. Projected free cash flows. There's a table with scenario, year 1 to 3 and exit multiple.
Okay.
Under the optimistic method, it's $0.5 million.
Year 1.
And on the year 2, it is $1.5 million.
Year 3.
It's $3 million with an exit multiple of 12x.
What is the meaning? That means they given the data for the best case scenario. If everything goes well, the startup company does well, the first year cash flow from the startup will be how much? $0.5 million. Year 2 how much? $1.5 million. Year 3?
$3 million.
It's going to be $3 million. And at the end of year 3, in case you want to exit, means you want to sell the startup to another entity, maybe you are acquired by another bigger entity, that happens, right? Or you want to sell your entity, that is basically shares in the entity, to the public, right? IPO. Then that is the worth of the startup. That is exit multiple. What I can do, it is 12 times the free cash flow. That is the meaning. It's like a price earnings multiple. Your price earnings multiple into earnings will give you what? The market value, right? Like that, it is 12 times $3 million, which is a year 3 cash flow. That means this startup can be sold to another entity, or this startup is worth how much? Will be worth $36 million at the end of year 3 in case you decide to exit your investment in the startup. Is that fine?
Yes, sir.
Yes, sir.
Then we have the base case scenario.
What is that? That's supposed to be the most likely scenario. The base case. How much for the first year?
$0.2 million.
Second year?
0.8.
Third year?
$1.5 million.
1.5 million. And what is the multiple?
10x.
It is going to be 10 times 1.5 million. That means in case a base case or most likely scenario, the startup can be sold for how much? $15 million in year 3. Got it? Now they given the
pessimistic.
What is that? Supposed to be the worst
case
scenario. What is the first year cash flow?
0.
Okay, goose egg. Okay, 0. And year 2?
$0.2 million.
$0.2 million. And year 3?
$0.5 million.
$0.5 million. And what is the multiple?
8x.
It is 8 times a 0.5 million. That means a startup can be sold for $4 million at the end of year 3. Yes, sir.
Discount rate is 20%.
20% is a discount rate chosen for discounting the cash flows. Then,
Time horizon is 3 years.
so it's given 3 years cash flow, right? But basically in 3 years time you will exit. At the end of year 3 you will exit. Got it? Either you will sell your startup to another entity or you will sell your shares to the public and walk away. Got it? Yes.
Probabilities. Optimistic 30%.
There is a 30% chance of the best case scenario happening. Then
Base case 50%.
50%,
Pessimistic 20%.
20%. Now the question is, you have been asked to value the startup. Very, very simple. You are supposed to calculate the present value of all the future cash flows under the 3 scenarios. So you'll get 3 different values for the startup entity, right? Under the best case scenario, most likely scenario, and the worst case scenario. Then what do? You are supposed to take the weighted average value of the entity. For that, you multiply the value of the startup into the probability of that scenario happening. Got it? So you'll get the weighted average value of the startup, and that is supposed to be the value of the startup under the first Chicago method. Is that fine?
Yes.
Now let's go ahead and take on the solution. Refer to the solution out there. Now first I made a table to find the exit value, right?
Yeah.
It is under the best case scenario. It's going to be 3 million into 12. How much?
Yeah.
36.
Yes, sir.
Yes, sir?
Yeah.
Under the base case scenario, most likely, it is going to be $1.5 million into 10x, right? 10 into 1.5, 15 million.
Yes, sir.
Under the worst case or pessimistic, it is going to be, it is 8 into 0.5, how much? $4 million. And then it is made a present value table. Got it?
Yes.
Now just see, the first row is going to be what? Optimistic. Or the best case scenario. Year 1, year 2, year 3, exit value and total. The present value, right?
Yeah.
Just see against the best case scenario or optimistic scenario. Year 1 cash flow $0.5 million into the discount factor at 20% for the first year. You all know how to find, right?
Yeah.
1 by 1.2. So $0.5 million into 0.833. And then for second year, $1.5 million into 0.69. 4. And then year 3 is going to be $3 million into 0.59. 579. And even the exit value is going to be $36 million into 0.579. Got it?
Yes, sir.
Now add up all the 4 numbers, the present values, and that is supposed to be the value of the startup under the best case scenario. How much?
24.04 million.
And do that under the base case or most likely scenario. Got it? That is $0.2 million, right?
Yes, sir.
That into 0.833. And then second year?
0.8 into 0.694.
And then third year, it's 1.5 into 0.579. And also $15 million into 0.579. And what is the total present value?
10.29 million.
Very good. And then what is the third one? The worst case scenario, right?
Yeah.
So 0 into 0.833. Then
0.2 into 0.69.
$0.2 million into 0.69 for the discount factor. And year 3 is going to be 0.5 million into 0.579. And also $4 million into 0.579. What is the total?
2.75 million.
Okay, the total, right?
Yes, sir.
Now you have 3 values for the same startup. Which one to take? What you should do? You are supposed to find the probability weighted average value of the startup, right? So what you should do? 24 point how much?
0.4.
That into 0.3, right?
Yes, sir.
There is a 30% chance, so 0.3 probability plus
10.29 million.
That into
5.
0.5 is the probability. And then for worst case is
2.75.
That into 0.2 probability. Now add up all the three numbers. How much you get?
12.9 million.
That is supposed to be the expected value of the startup using the first Chicago method. Is that fine, guys? So that is all. Very important from examination standpoint. Please go through. Good luck. Bye-bye.